Portfolio Builder members, welcome to our 1014 Monday Trade Alert where we play the SPY ETF. Quick little intro about our service and we'll jump into today's Trade Alert and the big news affecting our decisions. Daily income trade alerts at noon Eastern. They take a few seconds to put on. They're very easy to follow. Our target return of investment is 1% a month, and we've only had one losing month of negative 1%. With an average return of 1.6%. Now, if you use your broker's full buying power, it's 2 to 1, so you can actually double these returns simply by taking advantage of your brokerage's buying power. Now, for those of you who have been following us, we are optimizing the portfolio. Tuesday, we're getting out of SLV, which has generated some nice profits for us, and switching into emerging markets. So this is following the potential for a trade deal, and it does look like something will occur in the next 4 to 6 weeks, and the December 15th tariffs will be removed. We'll see if this really comes into play, and I've got a lot of news on that in a bit. But to summarize, I just want to point out our target return per set of equities is $750 a month with just a 1% return. And if we get close to that 1.5, you're looking at more like $11.50 a month per block of securities you buy. So you had to have 100 shares of the SPY. Monday, Wednesday, Friday, we trade those and take advantage of the 3 option expirations a week. Tuesday, a smaller position in emerging markets. And if you want to be a little safer, you can just throw out the Tuesday trade and keep this exact setup, and you'll be a little heavier in the bonds and a little less risk in the equities market. So again, we have 100 shares of SPY Monday, Wednesday, Friday, noon Eastern, 200 shares of EEM, which will be trading on Tuesday. That's emerging markets. So that's primarily everything connected to China. And I want to point out smash and grab. That's been a popular strategy by political leaders. They go in and smash an industry, and there's buddies come in and buy it up at a great discount. And so clearly we can see this time around with this administration, the big smash has been targeting emerging markets. So meanwhile, 200 shares of TLT, that's the long end of the treasury market, and we remain buy and hold into GDX. So while SPY, emerging markets, and TLT, we're trading with a collar, with options, limiting downside risk, also limiting upside potential. The GDX position is a simple buy and hold, and this is a 48% equities portfolio, 40% bond portfolio, and 12% gold. So that's what it takes to get started. Essentially, you'd have to deposit about 32.5 into your portfolio. They'll give you 2 to 1 leverage, and you could build this exact portfolio out. And we aim for a target return of $750 a month. So that breaks down to $3,000 a month for every $300,000 invested. And that's the average size, I would say, of most of our members at a minimum. So we do have a lot of people who are trading substantially larger accounts. But for this to really make sense, you do want to scale up at least to $300,000 if you can to get the best results with our program. Now you can get started, like I said, with a lot less just by building one set of this. If you want to make more money, just multiply it by 2, 3, 4, 5, how many ever multiples you want to do to reach your target income. Our simple 4 ETF portfolio is extremely diversified and all you'll need for retirement. We're aiming for income and safety, not growth or speculation. So think about it. Is it time to simplify your holdings, reduce your risk, get better results with less work, and weatherproof your retirement portfolio? Look in the description box for a 3-year financing plan to gain lifetime access to both our bootcamp and advisory. So I'll show that to you guys in a little bit. Or you can also call Dean. He's an expert options trader and can get you started with our program right away at 505-322-7515. Here's our disclaimer. If you go to the description box, I want you to know that there is a link to gain access to a lifetime membership to both our boot camp and our advisory, and it only costs $9.97 every other month. So as long as you do follow the program with at least one set of these securities, the program will pay for itself. So definitely check that out. Good morning, Tom. Good morning, Dean. Thanks for posting in the chat box. And for those of you who want to follow the program, but you're not quite confident you have what it takes, we now have that financing plan that will get you access to both of our programs. The trade alerts should potentially pay for the monthly payments and then some. So it's really on the house if you follow the trades and we deliver how we have. So here's a look at your 16-week boot camp that you'll get. It repeats every 16 weeks indefinitely. And so we will make sure that you know exactly how to follow the program with a Q&A webinar every Monday and then a lecture every Tuesday. And that's on top of our Wednesday, Thursday advisory webinars. So when you join, you'll actually have direct access to me where you can chat live 4 days a week if you want to. Now you don't need to, and again, we have designed this program to be very fast and on the go. Okay, so let's take a look at the Friday trade, and then we'll jump into the news and see how this is all affecting our overall strategy. So we had a $3.42 profit on the SPY Friday as the trade deal was shaping up. After the close, they announced with a joint conference with the Chinese representative and Trump that they were close to a deal. Still had some work to be done, and we'll look at that in a minute. But we can see the profit on Friday was $3.42 a share, and unfortunately, the TLT pulled back dramatically because of this risk-on move in equities, and now people are less fearful that they need to hold on to their treasuries. Now today, we get news that the Chinese aren't so sure they're ready to pull the trigger yet, and they want to make sure a number of things happen. So let's take a look at the trade alert we gave out on Friday and how it closes out today. So Friday, we sold the 302 call when the SPY was trading at 298. Let me zoom in on this for everybody. So all this means is we agreed to sell our shares for a price of 302, which is great because it's only at 298. Plus we get to keep this option premium of 25 cents. So from that standpoint, it's like taking candy from a baby. Even if we get exercised, great. We're in cash. We would get 302 a share and also keep that 25 cents. Now on the other side, we're taking advantage of the insurance companies, and that's Wall Street big banks who are willing to underwrite put options. And this was buy to open. If I go to here, you can see it was actually buy to open, a mistake on that image. And so this just means if the SPY were to go below 295, the value of our put option would make up for any losses below 295. So that put doesn't really kick in until we go below 295, but at that point, our losses stop right there in their tracks. So this is why we call these atomic bomb-proof trade alerts. We never have to touch them outside of the trading periods. And that's why we have such a high success rate of people who can actually get the results of our program. And that, again, is because everyone knows up front what we're trading, when we're trading it, and how we're trading it. So let's see what happened from this period to the next. And I do summarize it for you at the top of each trade alert. We gave back 234, so from Friday through today we're down $1 on the SPY overall, and that's because the Chinese, it's been an overall positive tone from them today, but it has not been as positive as Trump's remarks. So uncertainty is back, TLT will pop up. The bond market is closed today, but I do suspect we should see a nice bounce in the TLT come tomorrow. To summarize it, we need to track really two things. One, what happened to the SPY from when we entered the trade to closing the trade. And so if I do go back, you can see it was trading at 298.38. which we marked right here. As of closing it, it traded down to 296.33 for a $2.05 loss. So you can see that right here, 296.33. To close out the trade, we buy to close our call for a penny. And I apologize, this should be sell to close your put for a credit of 13 cents. Which we have right here. So I apologize for the error on that. We picked up 13 cents to get out of the caller, which originally cost 42 cents. So we had a loss of 29 cents, which brings our net result to negative 2.34 a share. Now what's the big picture? China is trying to get the December 15th tariffs removed. The Fed is actively injecting $100 billion a month into the Treasury market. And so this is freeing up capital in the bank's balance sheets to most likely buy equities. Meanwhile, the last time this sort of QE phase came through, gold and silver went through the roof. So we are still long GDX, the gold miners, but because of the potential for a trade deal, the Tuesday play is going to rotate into equities. When we have all of the world central banks lowering rates, printing money, and a potential major relief in uncertainty in the markets, it makes sense to add a little more risk to equities, especially real companies that generate profits. So that's exactly what we've done with this rotation into this exact portfolio allocation come tomorrow. So I'm still in silver and we'll rotate out of that tomorrow. Also, our put option on FXI, we closed out this morning and had something like a 27% loss on that. Again, that was our hedge in case the trade deal did not come through, as we had a long position in equities. Okay, let's take a look at the top news. Now we'll look at our spreadsheet as well. So we're currently down 0.2% in October. This is after being up 1.1% earlier in the week, and that was primarily from a huge rush into the TLT and SLV. So the SPY, I believe, will be our big money maker to close out the year, as well as emerging markets, but we still want to have the gold and treasury position to protect our portfolio from any surprises that the market's not anticipating. So most likely we'll watch the SPY and emerging markets climb a wall of worry as our bond and gold positions kind of just float around in nowhere land. That's what I'm expecting. So again, we'll have a little less exposure to the bonds, still 40% total portfolio position. I may tighten up that collar slightly. Let's take a look at today's SPY trade. So I think there's going to be a considerable amount of time before they can close the deal, which means we could potentially have a slow grind higher in the SPY in emerging markets. And so you will note that today's trade is a little bit skewed to lose more than make more because I'm not expecting a big drop in the SPY, but I'm also not expecting a big run up. So I sold the 297 call while we're trading at 296.32 for 90 cents. So we'll pick up at most $1.40 on the long portion of the trade. So the SPY shares plus the premium from the call option, our maximum profit between now and Wednesday is $1.40, but we got to give up approximately 30 cents for that downside protection on the put. So this is what I call a tight collar. It gives us a setup where the market can trade flat, go nowhere, go down a little bit, or go up, and we walk away with a profit. But we are more exposed to the downside, and we have very limited upside. And so I do suspect for the next few weeks this will be the best setup until we start seeing more signs of optimism from China. Here's the top content I've collected this morning. The hope is for a deal to be signed in Chile in November, which is about a month out. Meanwhile, we're not seeing Trump discuss too much with Hong Kong, and things are actually getting worse and worse in Hong Kong. Supposedly, lots of suicides, rumor of a girl being dismembered that was 15 years old, left in the harbor. Now this morning I saw something about a bomb being targeted towards the police. South Park has now 2 episodes making fun of the Chinese, which are very funny, but I'm surprised that they're even getting away with it. And they point out that Hollywood has been censored by China, even for U.S. films, because if they're not careful what they say, they can't go run the movies in China. So they're effectively censoring the entire world now if you want to do business with them. Okay, as part of the agreement, China would agree to some agricultural concessions and the U.S. would provide some tariff relief. They're talking about $40 to $50 billion of agricultural purchases, which would be more than twice the previous record before the tariff, which I think would really help Trump with the election. So I do suspect Trump would want to do this. Meanwhile, China's food problem is getting more and severe by the week as their pig population continues to drop in half every several months. So I think the Chinese will look like heroes as well by getting that food inflation down, and they've got a lot of mouths to feed. So I do think this trade deal can happen. I've been saying I thought this had a high likelihood of happening. Exactly this, that they would drop the tariffs in December and the Chinese would buy food. That's something that doesn't make either party look bad and provides some temporary relief. Where the sticky point continues is that IP theft, which we'll see if they actually get that built into this phase 1 deal. U.S. Secretary says the fundamental understanding on key issues, there's more work remaining. U.S. will not sign an agreement until it's on paper. China Liu has to go back and do more work in China. Meanwhile, Facebook's Libra project looks like everyone has bailed on it. And again, this is a period of time where all the central banks are being reckless with monetary policy, so I can see why there's sensitivity towards that. This tweet gave us quite a bounce this morning. Based on what I know, China-U.S. trade talks made breakthrough last week, and the two sides have had the strong will to reach a final deal. Initial statement of the Chinese side is moderate. This is China's habit. It doesn't mean China's real attitude is not positive. And then Northman Trader, China just got you to delay the October tariffs with nothing in writing. June 19, deal 90% done. May 19, good trade talks in China. February 19, trade talks very productive. So he's mocking that we've been saying this for so long without results. The U.S. must concede on its December tariff threat if they want to sign a deal during the APEC summit. Otherwise, it would be humiliating treaty for China. China's pork and beef imports surged in September as the pig herd shrank at a faster pace amid African swine fever outbreak. It had shrunk 41% year over year last month, and this month another 38% drop just in August. This is the tweet that did have the market very worried. Premier Lee, we will strictly protect our intellectual property rights. I guess their rights to steal and rip off, they're going to protect. So that, we'll see what comes of that. That is the big sticking point. Now for our bootcamp members, good thing we didn't short their currency yet. It has pulled back all the way to that 7 level. And I think if we don't see the trade deal shaping up by mid-November, we'll want to put that position on and expect that they will devalue ahead of the December 15th tariffs. At this point, though, I just don't see any major tremors hitting the markets. between now and that November 15th. So we'll see if any bad news hits. We have our bond position primarily sitting there to protect us from surprises. Secretary Mnuchin outlines the next steps in U.S.-China trade talks. 1, principal level called next week. 2, deputies will meet between now and Chile. 3, Lighthizer, Liu meet in Chile before leaders. 4, Trump and Xi meet to finalize a deal. Meanwhile, the PMIs are red around the world with only a few blue spots, or rather green spots. And this is why we see the central banks are aggressively lowering rates, printing money, and this means you want to be long stocks without some sort of major financial scare or some sort of systemic risk going through the system. Now, normally they wait for stocks in the U.S. to crash before they start up quantitative easing. But the last time the repo market was doing this was right before the 2008 crash. So I think they've been learning. In fact, we've seen from the 2000 bubble to the 2008 bubble to this potential recession, the Fed is trying to get ahead of any disruptions and aggressively use monetary policy. So again, we don't want to fight the Fed. We want to own gold and have that bond position. Meanwhile, I'm not worried about bonds getting destroyed right now because we know their overall scheme is going to be to drop rates towards zero while saying they're not going to do it. We can just look at the German yields for a good indicator, and we're already seeing them put about $100 billion a month into the markets, and I believe they're going to announce a plan to put a one-time injection of something like $500 billion or more just to give some extra liquidity to these big banks because all of their dollars are trapped. Now, the big picture is the banks have much better requirements for how much cash they should be holding, so that could be a little bit of the explanation. Plus, we're having massive treasuries come through the system right now because of our huge deficit. So that is something I'm carefully looking for. Also, are there banks overseas, like, or at least investment funds like SoftBank, who just lost billions with WeWork and a bunch of these overrated IPOs in tech companies? We're seeing Hong Kong potentially lose their stock market setup because of all this drama, and now Macau has submitted a proposal to create a yuan-denominated NASDAQ for Beijing, which may be approved by mid-December. So this is interesting. If you look at Kyle Bass's pick to short the Hong Kong dollar, this could potentially be the move that would really, really hurt Hong Kong. Now, WeWork potentially going bankrupt is causing a shockwave in the real estate markets. But luckily, the real estate markets are being supported with this massive QE and dropping rates slowly but surely to zero. And look at that valuation from $45 billion down to $10 billion in just a year. And will it go bankrupt? Time will tell. Apparently there is a emergency webcam meeting October 4th with the FOMC meeting members, which is where they launched Not QE, which has become the next joke. Trump, my deal with China is that they will immediately start buying very large quantities of our agricultural product, not wait until the deal is signed over the next 3 or 4 weeks. They have already started. Likewise, financial services and other deal aspects start preparing. I agreed to not increase tariffs from 25 to 30% on October 15th. They will remain at 25%. So it's interesting, we really didn't give up much, just a 5% increase this month, and then maybe not increase the tariffs in December. Meanwhile, we're getting them to potentially buy food, oil, and a bunch of planes. So interesting to see how this is developing. We have the election coming up. Meanwhile, this quote came out: anyone attempting to split China will be crushed, and any external force backing such attempts will be deemed by the Chinese people as pipe dreaming. Hunter Biden steps down from the Chinese board. This is a huge hedge fund that was set up for Hunter Biden to basically buy up U.S. companies and transfer IP back to China. So a lot of drama circling in that. Elizabeth Warren continues to stir up all sorts of trouble, and this is pretty funny. She went and, here's her ad. We intentionally made a Facebook ad with false claims and submitted it to Facebook's ad platform to see if it would be approved. It got approved quickly, and the ad is now running on Facebook. Take a look. Breaking news, Mark Zuckerberg and Facebook just endorsed Donald Trump for re-election. You're probably shocked, and you might be thinking, how could this possibly be true? Well, it's not, sorry, but what Zuckerberg has done is given Donald Trump free rein to lie on his platform. Elizabeth is the primary threat to Facebook, and you better believe they will do whatever they can secretly to undermine her campaign. And she really hasn't made any friends that I can see in the rich camp. So we'll see if the Democrats let her hold that primary position or if Hillary comes in to save the day. Looks like Joe has really lost all chances. So fun to watch for sure. I think there's another Democratic debate coming up. But she is definitely winning the vote of the average Joe, at least if you're not a Trump supporter. So I definitely had underestimated Elizabeth early on. I thought they were trying to put Joe in or maybe Kamala Harris. But Kamala was just too just angry in general about Trump, I felt like, and quickly lost her polling power. Would assume that this whole Ukraine whistleblower call was designed to knock Joe Biden off his chance, which I believe that has been accomplished. So now we have this Elizabeth Warren who could disrupt a lot of things. So definitely going to have to pay close attention to this as we get nearer and nearer. Meanwhile, the other thing to really be concerned about is inflation. Now the Fed says they want asymmetrical inflation. They want it to overshoot 2%. And so I think they're going to get what they want in no time, which is when this whole central bank bubble up party will come to an end. And just look at 2018 for an idea of what happens when inflation gets too hot. They have to raise rates, and that becomes negative for bonds and stocks at the same time. Some stuff from Hong Kong. Arrests of 750 children during protests spark outcry. Hong Kong officials say a third of 2,379 protesters arrested during 4 months of protests are under 18. Look at the charts. SPY ETF is dying to break above that 300 level, and we've had a good reason for it not to, with the uncertainty with the trade war. If we get this phase one deal in, I suspect we have a very sharp rally to the 315 to 330 range, which I would call the danger zone, and then we need that phase two to not have trouble probably going into 2020. TLT, I suspect, will travel higher, even without too much trade uncertainty because of the overall moves of the central banks. Right now, they're in the 1.75 to 2% federal funds rate, and most likely that will drop all the way to zero at some point in 2020, unless this trade deal is just immediately rectified and all the PMIs jump above 50, which I think is highly unlikely to happen that quickly. So I do suspect the TLT should travel higher just all on its own, and plus it provides that awesome buffer to our stock position in case the trade talks break down, or who knows what sort of drama could come out from where that could create another scare in the markets. So we do continue to hold a large TLT position as our insurance policy. Emerging markets has a similar position size in our portfolio now that Stanley Druckenmiller has. who has averaged about 30% a year for about 30 years. He's up there with Ray Dalio and a handful of legendary hedge fund managers. You can watch their 13F filings for good ideas. They've all been wanting to dump money into emerging markets for quite some time, from Jeffrey Gundlach to Ray Dalio to Stanley Druckenmiller. And so if we do look at what's happened in the last year, think of the old smash and grab analogy from the Obama era. Well, the smash has been in China, and so you can see it is down a good 20%, almost 30% from that 2017 high. If we get a resolution, I suspect this emerging markets has a nice rally back to that $52 to $60 range, which would mean potentially a 50% return in our Tuesday play into the 2020 election. And that again is if phase one comes into play. I'd suspect this could jump towards 45 to 50, get that phase two, and who knows, this could go significantly higher. A lot of big players want to go long the emerging markets, and again, smash and grab. We just watched a massive smash for almost 2 years. Is it time to grab? We'll see. Meanwhile, as long as they're printing money, funneling it into the treasury market, we want to be long gold. This is 10% of our portfolio in GDX. That's the gold miners. Most of the gold miners are just now getting around to opening up their mines and getting that barbellic relic out there so they can sell it to the central banks, who know they need to have a lot of gold in their central bank to back up all this funny money they're printing. Now in our portfolio, we have, of the 10% in gold, we actually took 2% out to buy Bitcoin and Ethereum, 1% in Bitcoin, 1% in Ethereum. That has generated a very large return this year for our portfolio, as we got in at very, very low prices on both of those and remain a hold. Dollar index continues to be very strong, and this is troublesome for emerging markets as they have to pay all their debts in dollars. All the dollars around the world have been soaked up into treasuries, so there's a dollar shortage. Now, I think we'll see massive money printing from central banks around the world to deal with this, and that'll be very bullish for stocks. So that's why we now have the emerging markets position. Meanwhile, here's that BOOTCAMP trade to short the Chinese currency. We were waiting for a nail in the coffin to pull the trigger on this one, and probably going to be next month now. If we don't get that trade deal in shape, we will definitely want to put this on ahead of the December 15th tariffs. And I think right now it's at 7 almost, just a little bit above that. And if we do get the tariffs in December, I'd suspect they would have to go past the all-time high of 7.2. So that's a trade we're still sitting on patiently. Meanwhile, gold still remains at this $1,500 elevated level, which is great for the miners. We were playing silver until we saw what happened with the trade deal. If it had broken down, we'd want to continue holding silver. But because it does appear like the two can come to at least a phase one deal, I think we want to take exposure off the table from precious metals. We already have 10% in GDX, so that's already a huge position for gold. Now that German 30-year bond for first time in several months is at a positive yield, which is signaling the same thing we've seen in the TLT, as they are super correlated, but the long-term trend is still towards zero, as the German 5-year and 2-year are almost negative 1%. So you're losing almost 1% a year to loan money short-term to the Germans. So all the trouble is certainly not gone in emerging markets, and I believe U.S. rates have further to drop. Now I do want to point out, since the high of the equities market in July through today, we're really down about 1.5%. Yet our portfolio, so if you take the August through today, you'd probably be down about 1.5%. Our portfolio is up 1.9. So we're still doing well despite this relatively tough markets to trade, as the SPY cannot make up its mind, nor can the leaders of the US and China as to where we're headed with this trade deal. Okay, thank you guys. Tomorrow we will rotate out of silver into emerging markets, and Wednesday back to the SPY.